Welcome back to another episode of Singapore's Real Estate Explained, brought to you by the JNA Investments team. And today we'll be talking about
the effects of the possible US recession on the Singapore property market. So recently we noticed the stock market very volatile, Trump coming with all the tariffs. So how will it affect the Singapore market in the short term and in the long term run?
Yep, so let's dive right in.
Right, so before we start, I'd like to thank all our clients who have supported us. Currently, our good reviews have went up to 168 5-star review. Thank you for supporting us thus far. And our channel have grown to 16.6K. So if you'd like to have more investment content coming up or real estate market knowledge that is inputted into this channel, do hit the subscribe button and give us a like.
Okay, and we've served more than 700 clients with an average return of 19.56%. So if you're in the market looking for a next investment home and you want to speak to any of us from the investment team, do contact our QR code at the bottom and we'll have someone reach out to you.
Alright, so without much further ado, let's begin today's topic.
So after all the hoo-ha on the tariff, increasing and decreasing and fighting each other, right? I think at this point, US and China have said that, they're going to do a 90-day pause on it, meaning the tariff will drop 145% to 30% on the US imports, and for China imports, it will drop 125% to 10%. So the 100+% was quite crazy. Like, at least now it's on a more reasonable level. And we would have seen the market actually rallied up the last few days.
Yeah, in fact, the stock market went up about 5%. Okay, after it dropped like about 10%.
Because Trump tweet, please buy stocks.
Please buy stocks.
So you want to know, okay, not the best advice lah, but what we've seen is Trump will go and tweet buy stocks and then the market would have gone up after that.
Yeah, by the time you notice you buy stocks, the whole market went up.
Yeah.
So the market will be very volatile. But the key thing to understand is how would then this affect the Singapore property market, and from there, see how in the past, tariffs, we look back at 2009, this did happen before. How will it create a long-term effect on the property market in Singapore?
Okay, so let's take a look what exactly is a US recession and whether it's something that will actually happen. So what is a recession is when there is 2 consecutive quarters of negative GDP growth. That's when people say, okay, a recession is coming up. So why people say a recession is coming? Because if you were to look at the GDP, we realize that it has been positive for the last year. And finally, this year, Q1, we've seen a negative GDP. And then people are saying, hey, if this quarter is also negative, is it a start or a sign of a recession happening?
Yeah, so let's trace what really causes like slight negative for GDP. So in terms of GDP growth is contributed by a few factors. One is consumer spending, how much you spend. Second is amount of investment, okay, government spending, export and imports. Okay, so the interesting part is when imports were to increase, means the government import more into their country rather than exporting. What happened is it does contribute to the GDP drop, because you're bringing more goods in and spending outside as compared to bringing your goods out to sell.
So I think that's when a trade deficit happened, and this could also be the reason why Trump actually started this whole tariff thing in Q2 this year also.
Correct. And it actually created a whole, panic in the entire global market. And with this uncertainty, in fact, JP Morgan research increased the potential of US recession from 40% previously in 2025 to 60%. So in this case, how will it affect Singapore market?
Okay, so interestingly, usually when a recession happens, employment goes up because businesses lay off workers, people spend less money, and then business make lesser profits, and then the whole cycle repeats again. For now, I think unemployment is still unchanged, so it's not affected greatly yet. Definitely, maybe people are not getting laid off yet, but people are definitely spending less money because there is uncertainty, there is a negative outlook in what is exactly going to happen. And interestingly or ironically, when they spend less money, it actually contributes to the whole recession that they were actually afraid of.
Yes, those are self-fulfilling prophecy. But as compared to COVID-19 times where unemployment went up with 70%, this is not as bad.
Yeah. So next thing we'll look at is will Fed actually cut rates? Because this indirectly affects the interest rates in Singapore. And I think there is 2 parties now. One is Trump, who is wanting to cut rates, and then there's Jerome Powell, who doesn't want to cut rates so quickly.
Okay, so when people sense there's recession coming, they really hope that Fed will cut interest rate, because this higher interest rate have been there for some time. Okay, in fact, Trump is very pushing for this. Okay, what they want to do is allow Fed to cut this rate as a countermeasure to the expected economic downturn and a rise in inflation from tariffs.
Yeah.
So why try pushing for this interest rate cut? It's also saying that because grocery, gas, the prices are already coming down, the inflation is not as bad. So why don't we make borrowing costs cheaper and give this economy a boost?
Yeah. But Jerome Powell is not rushing it. I think they are trying to hold it steady because they feel that, with the tariff, Trump says prices are falling, but they feel like because of the tariff, there's going to be inflation. And when there's inflation and I drop the rates, right, the inflation is going to go even crazier, which is something that the Fed doesn't want. And when it goes crazy, then they have to drop the rates later on again.
Yes.
Yeah.
And this situation escalated to the extent that Trump would suggest he wants to remove power if he's not happy with own interest rates. So, I mean, all these threats are happening.
Right. He's calling him the too late power.
The too late power, yes. But one thing for sure is Jerome Powell wants the rates to be cut in the long-term run. And it's a matter of time, but interest rate will be coming down. Because Trump wants to accelerate this process, which is why he came out with all the tariffs to trigger this.
So Trump is trying to fire power now. But he may not have the rights to do so.
Yep. So with this, let's take a look at the historical US recession and see what is impacting Singapore property. And most importantly, is there any similarity? If there is no similarity, what is the difference that make this situation more unique?
So in 2008, when the Great Recession happened, it was actually due to a lot of excessive borrowing. And this actually created an asset bubble, which in Singapore, sometimes you call it a property bubble. Basically, people borrowed more than they can afford. And when things happen, everything just came crashing down. Yes.
And in fact, if you look at the 2007, December to June 2009, the market actually went down, huge, because people borrow way beyond means. They cannot afford. When market goes south, what they do is they have to end up liquidating a property in order to sell to pay off their mortgage, or else they had to declare bankruptcy. So that was 1.5 years of turmoil.
So COVID-19, we actually in 2020 saw another recession that happened, but the difference is this was very short-lived. It wasn't as long as the previous one. And reason being also, it was after the 2013 where all the cooling measures came in. There was TDSR, which we'll talk about later. There's LTV, there's ABSD in place so that people couldn't over-leverage. And that's why even when there was uncertainty, they didn't go in a frantic selling also.
Yes. And look back in the past, besides 2008 global financial crisis, there was 2000.com, 1996 Asia financial crisis, 1980s depression. So you can see what we did over here is that we plotted the property price index, against that of the real GDP. And we noticed one thing is a huge-shaped formation of the blue line exceeding the orange line below. And this is a sign of a bubble. But in 2013, there came your TDSR, and that changed the entire game. So how does TDSM measure affect the Singaporean market? Is to answer this very important question is, in the times of recession, can Singaporeans still pay the mortgage even if you have to go jobless?
I think three main things that the government did right was actually TDSR, LTV, as well as ABSD. Meaning TDSR, you cannot maxed out your income to borrow. You can only use 50% to pay off any debt. LTV meaning you cannot borrow the whole 100%. You can only borrow 75%. And ABSD making sure that everybody can only buy one. You can buy more, but usually people don't because you have to pay almost 20% for additional property.
And the most important one is TDSR, because before 2013, someone with 10k income, 30-year-old, at 3% interest rate market, they can borrow about 2.174 million. But this borrowing power actually dropped after 2013 to 1.336. So people can no longer over-leverage and borrow way beyond their means. And this itself gave the market a very strong buffer. And this amount actually dropped to 1.085 million later on in 2021, where government tightened the TDSR even more. So from 2013 all the way to 2025 today, 12 years, people no longer can borrow as much. They don't borrow way beyond their means. And most importantly, over time, they actually had more savings. So this gives a very strong buffer in a time of recession. When it comes to market uncertainty, people are no longer in the need to want a fire sale to move on, but they'll hold on to their prices.
So next thing we look at the Singaporean saving, because being very prudent, I think everybody in Singapore grew up the mindset of saving, right? We don't really spend the entire monthly income. Hopefully not. So we will see here that in 2024, the statistics show that we save close to almost 40% of our income.
And with more savings and prudency and not over-leveraging and borrowing too much loan, what you can see over here and on the right-hand side, the total asset value, which includes your cash, your CPF, your property assets, as compared to liability, the gap has been widening ever since 2013. To the extent that we have a bigger buffer where when you take asset minus liability, your cash unlock in terms of your equity will be actually much higher than before.
So if we take a look at the Singapore household balance sheet, what you see here is actually a year-on-year percentage change. You'll notice for asset-wise, it has been on a 7 to 8%, meaning the value of asset actually grows on a 7 to 8% basis. But for liabilities-wise, it's between the 1 to 4%. So we can constantly see that actually the asset growth is higher than the liability that people actually have in Singapore.
So the cash flow position is going stronger because you're rising faster as compared to your liability. And with this over the years, you can see today's Singapore liquid cash flow, which consists of your cash deposit and your CPF ordinary account. I exclude special account and your RA account out from this. You have a total $855 billion of liquid free cash flow, which is almost 3 times that of liability, which is $364 billion. So this shows that our balance sheet is very, very strong. And this does have the ability to go through any kind of recession in the downtime.
And when we look at holding power on how long someone actually holds their property on average in Singapore, it's about 9 to 10 years. It then shows that actually there are still a lot of Singaporeans that buy for own stay. Not so much on a flipping mentality of 3 to 4 years. Yes, there is, but generally average people still hold on a slightly longer term. And the percentage of people selling within the 3 years means paying SSD. Because of maybe, let's say, they found other opportunities or they happen to not be able to pay their mortgage is less than 5%.
Yes, and with this, because some maybe investors are investing, they don't borrow as much mortgage. And this actually allows the entire economy to be more stable. So for more individuals who are looking at property as a long-term investment rather than a short-term flip, we don't see as many people over-leveraging to borrow more just to buy the flip. And if they even they want to, they are not able to do so because there's ABSC involved. So this creates a long-term market stability. And in a downturn, people will just hold the property because it's primarily for own stay.
Yep.
So with this in mind, okay, let's see how then would this potential US recession affect the Singaporean market this time. Okay, so one thing they mentioned, originally GDP was supposed to be an upward trend growth, 3.8%, but they downsized because of this uncertainty, the 0 to 2%. So thank God, still not negative. Okay, still a very decently positive outlook. Okay.
So for mortgage rates wise, we follow very closely with the Fed rates. If you have to look at the graph, every time the Fed goes up, after a while we go up. So there is a delayed effect, but in general, we do follow their trend. So if US do cut their Fed rates, what we can expect is a lower interest rates for mortgage in Singapore also.
And it ties in very nicely with this SNIL policy, monetary policy coming in Singapore, that they want to cut interest rate in the long-term run to stimulate the economy and allow borrowing to be easier for SMEs and banks and even consumers. All right. And with this also, there's uncertainty in the market. Interestingly, we see more money coming into Singapore. Okay. In fact, they call Singapore a safe haven. Okay. And why so? Is if you break down the entire 2024 best country to invest in or do business, okay, the top is Singapore.
Yeah.
Okay. And if you look at why Singapore is a safe haven, in a recent survey done by CEO World, you can see Singapore is ranked number 1 as the world's best country to invest and do business in. Okay, in terms of economic stability, government policy, and skilled labor force, they are all ranked top. And this is when market is uncertain. Okay, most of the country want to invest in a place where stability shouts out.
Yeah. Whatever Chris has mentioned, the other thing that people really look at Singapore is how strong the currency is. So if you were to look at Sing dollar versus US dollar in the last 5 to 6 months, you see that it actually went up for 4.5%. This means that by doing nothing and holding Sing dollar, your money actually became 4.5 times more of value. So when we look at the COVID period, let's say the last 5 years, Sing dollar versus US dollar, it went up by about 7.59%. Yuan went up by about 10.6%. Other currencies with bigger differences are like the Malaysian ringgit, which went up by about 9%, as well as the Indonesian rupiah, where Singapore actually went up by about 28%. An example would be if someone from Indonesia bought a property, converted their rupiah to Sing dollar, and they bought a property here, and the property didn't appreciate, they will still have made the 28% due to the difference in the forex. So when a lot of people actually park their money in Singapore, it's really to mitigate the risk of the depreciation in their own currency.
Yes, in fact, recently we had quite a few clients, Singaporean working overseas in the US, and coming to us and say that, hey, actually the market is volatile right now, and I feel the currency for US will weaken the long-term perspective. They actually do FX trading, and they do FX analysis. So they actually say, I want to divest back to Singapore, so that even by holding Singapore currency and investing in property in Singapore, it helps to safeguard their wealth. And even recently, we have a case of a US citizen in Singapore also have this similar sentiments. So that's something that in the long-term run, if you're just holding Singapore property, it's not just about property itself, it's also about the currency strength. They look at Singapore dollar.
Okay, so the last time we actually had a small recession, whether it's due to the Trump tariff back in 2018 or whether it was due to the COVID period in 2020, right? What we'll do is we're going to look back at that time, what were some of the launches that actually launched and how they have performed in such uncertain times.
Yes. So the first candidate we have here is Treasure Tampines, a mega development. Now it's well known. Okay, there's one that make a lot of money. But fun fact, back then in 2019, it was actually in the midst of trade war. In the midst of China and US trade war, it was very uncertain. They say recession is coming. It was about 60-70% chance of recession. And COVID-19 came. Double whammy. And that itself, even at launch day, only 13% was sold. Okay, but if you look at where we are today for Treasure, okay, a lot of people may not know, launch day was very badly received, but today they make on average for 3-year premium about 400 to 500K.
Yep. Next example we will look at is Florence Residences, also during the 2019 period, and you'll notice the take-up rate is only 6%. So at that time, yes, there was a lot of uncertainty, but if you look at their premium 3-beta average returns, it's also about the 4 to 500,000 range.
And next, we have this project. Okay, not just launched at the wrong time. Okay, location is very off the grid at a Flora Drive area. This is called Jovel. Okay, and you can see on launch day, okay, launched it just after Trump came out with the great trade war with China back then. But then so 9.6%. On launch day, I remember only 3%. No one bought any of the units there because location is so bad. It was one of the worst product in the market, according to inverted comma. And fast forward today, you can see that the whole property actually appreciated about 18%. Quite a decent returns for a new launch, and fetching about 250 to about 300K profits.
Last example we'll look at is Q Residences. Also during the COVID period, again, 26% take-up rate is not something that we'll see today. Today, we are used to all the big launches that sell at like 70, 80, 90%. This was a take-up rate at that time because of uncertainty. For their 3-beta premium profits, average, you will also see that it ranges from between 300 plus to about 500 plus thousand.
Yeah. And if you look at other projects, okay, breakdown like Dean Tree, View at Kismin, Spark Clementine's, Momentum Park, they all launched in 2019, even 2020 period where the market was very, very uncertain and Trump was doing the same thing as what we're seeing today. You can see the take-up was 14%, 21%, 22%, 32%, and you can see the average returns for 3-beta, the profits ranges from 370K to even up to 500K for Park Clementine's. So the things that we notice when the market is uncertain, okay, and we have a strong fundamental to show that our property market is resilient in Singapore, what we can do instead of the fear that we have, are we able to leverage on this to find, are there any good products in the market that you consider? But with that in view, right, it doesn't mean every product is a good purchase. You have to really do your due diligence now to be able to find what exactly is the right property to invest in.
So I think when there are uncertain times in the market like COVID, when a potential recession is happening, Singaporeans are generally on the wait and see approach. And that's why it's common to see that take-up rate actually falls. You don't see the 80-90% when the hype is over there. But it's during these times where you say, okay, when the market is not looking, are there opportunities for us to enter as you wait out? So don't see property like stocks where, today you enter, you see it exiting it tomorrow. It's not as volatile because of the 3-year holding period that you have. So because of the opportunity cost that you're going to be holding for 3 years, make sure that your numbers and analysis are done right in picking your right investment unit.
And with this, we'll come to the end of this video. I hope they got a greater insight of how does the US recession affect Singapore property market, and most importantly, how are we able to leverage on this to be able to find opportunities.
So if you're in the market and you're looking for a next investment property at this time, you can always reach out to us and we'll have someone speak to you. With that, we'll see you next time. This is Grace.
This is Christian.
Bye-bye.
Bye.